Hi guys. So today we're going to learn a basic overview of options. We're going to learn what are options, some unique advantages that options traders have over stock traders, what are calls and puts, some options lingo, also a couple examples of buying power, and one easy way to profit from options so we can make some money. That's the name of the game, right? Now, let's start this course. So what are options? A option is a contract allowing the buyer the right, but not the obligation, to buy or sell the underlying security at a known price in a known predefined time frame. So basically, what I'm trying to say in simple English is that a a option is a contract, okay, allowing the buyer the right, but not the obligation, okay, to buy or not to buy a security or to sell or not to sell a security at a known price, which means the strike price, in a known predefined time frame known as the expiration date. So why do option traders have a unique advantage over stock traders? In general, option traders make more money than stock traders. Why, you ask? Because option traders have way more tools than a stock trader. You have tools to start building and growing your account and getting closer to financial freedom. You have benefits like buying power with less risk. Second, you make way more money. Third, you can make money in a bullish market, up, down, bearish market, and a sideways market. You have so many benefits like less total risk. You can leverage your money almost tenfold. You also could insure your investment, hedge risk. For stock traders, you could only make money going up and down, but when shorting, you're liable for so many risks, and that's when you get margin calls when things go bad. And trust me, you don't want a margin call. By the way, a margin call is when your broker calls you because you need to put more money in your account because you're losing more money than the initial capital you started with. That's not good. Let's go to the next slide. We're going to talk about calls and puts now. Calls are used for bullish strategies. Calls are contracts you can buy to control a stock for a certain amount of time and a predetermined price. If you buying a call, you're assuming the stock is going up, and that's a bullish strategy. On the other hand, there's puts, which is a bearish strategy. If you're buying a put, you're assuming the stock is going down, and that's how you make money with puts. And you will see later on how you can use puts for other cool things. Now, let's go to the next slide. This is basically some options lingo. All right, let's start with strike price. Strike price means that someone is willing and has agreed to sell you or buy the stock at the underlying price. Stock price is basically the agreed upon price. Remember that. We're going to talk about that a lot in the next few slides. Next is one option contract equals 100 shares. One contract equals 100 shares. So that means one contract equals 100 shares of the underlying stock. Expiration date. Expiration date is the date of the option contract expiration. So basically, it means the days left until expiration. In the money is the portion of an option that has value if the contract were to expire. So meaning if the contract were to expire, say tomorrow, that's the intrinsic value that it has. And we abbreviate this by ITM. At the money means when an option strike price is the same as the current price of the underlying security. So for example, if Amazon is trading at 750, at the money will be 750. Out the money is when the option has no real value. Meaning if Amazon's trading at 750 and you buy an out the money option, you buying say example 780 around there. Okay, so in this slide we're going to talk about stock buying power versus option buying power. So here we have example XYZ stock. XYZ stock is trading at $100. So if you want to buy 100 shares of XYZ, which is trading at right now at $100, you're gonna have to multiply 100 shares times $100. So basically, you need $10,000 to buy XYZ. Now, in this slide, we introduce the option buying power. So now, if you buy one contract at a $100 strike price, call option, to control for 30 days at a cost of $10 per option. Remember, $10 per option because there's 100 shares, so $10 per option would equal $1,000. So basically, you're paying $1,000 to control the same amount of stocks you would buy with $10,000 using stock buying power. Now tell me, would you rather control XYZ stock for $10,000, or would you rather control 100 shares for $1,000 for 30 days, assuming that you know or assume that the stock is going up within those 30 days? In my opinion, I'd rather control 100 shares for $1,000 instead of putting $10,000 of my capital at risk. But hey, that's my opinion. Please let me know yours. Uh, well, in this slide, we're going to show you stock buying power versus option buying power. We're using the stock AMZN, which is Amazon. So if we buy 100 shares of Amazon using stock buying power, we're gonna have to pay $48,000. $48,000 because 100 shares times 480 equals $48,000. And I know most of you guys don't have $48,000 to even invest, let alone use it as capital risk. Basically, you're risking this capital just to get a capital gain, basically. Now with option buying power, you can, with one contract which equals 100 shares, you could buy it at the premium of $60, and it'll equal $6,000. So with $6,000, you control the same amount of shares that if you would have bought with $48,000. So I don't know about you, but I would rather use the $6,000. And it's $6,000 because we're controlling it for 35 days. If you would control it, say for a week or two, which is 14 days or 7 days, then it will be much more cheaper. So so here we have support and there's a resistance. So if we was to buy Amazon, let's say right here, and just enjoy this beautiful breakout all the way to the top, this would and this would just be amazing. This would be amazing if you get a breakout like this. So now if you have the $6,000 and you would invested in Amazon right here at the support and just rolled it all the way up, you would have made an easy profit of $32,000. Now, if you would have used stock buying power and you would have invested $48,000, you would have got the same profit. This is hypothetically meaning that you're deep inside the money, by the way. Okay, now I'm going to explain to you why at times stocks are more risky than options. We're going to use XYZ stock as an example, as we used last time. XYZ stock is at $100 right now. That's where it's trading at. So if you were to buy 100 shares of XYZ using stock buying power, we're going to buy 100 shares at $100, which equals $10,000. Now, if you look to your right, using option buying power, if you were to buy one contract, which equals 100 shares times 10, which is $1,000, now you have $10,000 on your left side with stock. Now you have $1,000 on your other side with options. Now let's assume that XYZ stock falls $50, which it could happen. Just say bad earnings, it had bad earnings this quarter, and people start to sell off. Okay, now you have two scenarios. With stocks, scenario A, you lose $5,000 because from $100 and you lose $50, you're left with $50 basically. So $50 times 100 is 5,000. So you basically lose $5,000. That's half of your capital, 50% of your capital right there. Now with options, say XYZ stock falls $50, scenario B, you just lose $1,000. You just lose the capital you invested. So in my opinion, options is less risky. In scenario A, you lose $5,000. In scenario B, you just lose $1,000. CMG. Now this is the stock side and this is the option side. So this is resistance, support. Okay, so if you would have bought CMG at $112 right here, 100 shares times 112 equals $11,000, $200, 11,200. Okay, if say perhaps the stock falls, because remember, Chipotle Mexican Grill had the mad cow disease. I forgot which disease it has, but it really causes the stock to go down. So stock falls from 112 to 87, which equals $24.12 of a loss basically. And if you would have 100 shares, which you would have lost $2,412 as a stock. Now, if you had options and you would have bought one contract and say the premium was $7, so remember one contract equals 100 shares, so 100 shares times 7 equals $700. And let's say the same thing happens, the stock falls $24.12. You would have just lost $700. So this is just another example, but using a real company. And then again, guys, this is a no-brainer. I'd rather lose $700 than $2,412. I'd rather, it's always better to lose less, in my opinion. But then again, everyone has their own opinion. Okay, so now we have put options. What are put options? So put option gives you the right to sell the stock to someone else at a predetermined price and by a certain date. So basically, put options is almost the same thing as shorting. You want the stock to go down. Remember, put options is the same thing as shorting, but not, but doesn't have the same risk. You're just limited to a certain amount of capital. While shorting, You're not really limited to anything. Now, I'm gonna show you. Also, I'm gonna show you how to use put options as insurance for your investments. Okay, so now I'm gonna show you how to use put options to make some profits. So if you would have bought Tesla, as you see there, at 230 and then sold around 200, you would have profited $3,000. So if you would have bought one contract, meaning 100 shares again, at a strike price of 230 at the money, with a 30 days to expire, and you'd have bought each option for a premium of $9. So $9 times 100 shares equals $900. And you would have sold as soon as it hit $200. You would have profited $3,000 easily. I actually did this trade. I love Tesla. Tesla's cars are amazing. But the thing is that what happened during this period was that it came out with negative earnings because Tesla has so much debt. If you look at the financial, the balance sheet, the income statement, you see what I'm talking about. But overall, I love Tesla. Tesla's a good stock to use options for. Okay, so now on this slide, I'm gonna show you how to use put options as insurance. Okay, so example, we can use XYZ stock. Remember, is this is an imaginary stock. Uh, okay, now if you were to buy 100 shares at $100, it would equal $10,000, right? So right now you have in your account you have 100 shares of XYZ and a market value of $10,000. Yes, that's amazing. Now, a smart investor, he would use options to hedge their risk. Hedge meaning just ensure. That's what I'm trying to say. Hedging meaning means ensure, basically, in simple terms. So now, if you were to buy one option contract, one put option contract at $100 strike price at a $4 premium, so one contract equals 100 shares times 4 equals $400. Just you're spending $400 just to ensure your $10,000 investment. Now, let's say stock XYZ falls $50. Why? Let's just say hypothetically the CEO was cooking the books and he was stating that he made $1.2 billion in this quarter. Well, let's not say that. Let's say in this year, like say for example Enron or like ZBest if you're an accounting major or anything. So now since you bought that strike, that put option, you're hedging your risk basically. Now, if the stock XYZ falls $50, instead of losing $5,000, you're just gonna lose $400, which was the initial investment just to ensure your $10,000. That's pretty amazing and mind blowing. And this is what like professional use to hedge their risk. So they buy as many contracts as they have shares just to hedge their risk if they feel something is gonna happen, say through they buy it through earnings or some radical news of say some interest rates is going up or anything happen. The kind of the markets, just basically anything that can affect the overall market. Okay, so now we can use a real life example of put options as insurance. So let's say you buy 100 shares of Tesla at 240 market price. That means 100 shares times 240 equals $24,000. So right now you have in your account you have 100 shares of Tesla and a market value of $24,000. Now, the smart investors as we are, we buy one option contract to hedge our risk of the 100 shares we just bought of Tesla. Now, we per se we pay $5 a premium per option contract. Per option, sorry, not per option contract, per option. So 100 shares times $5 equals $500. So right now we just paid $500 for insurance to hedge our risk if something were to happen. Now, since Tesla stock tumbles all the way down, we are smart people and we had the options. Now, if the stock falls to $200, meaning it lost $40 of market value, if you didn't hedge your risk, you would have lost $4,000. That's assuming that you would have sold at $200. In this example, we assume that you sold at $200. But since we are not pigs and we're not going to get slaughtered in this market, We used the put option and only lost 500. And let's say we sold our shares at $200 and let our option ride all the way to 151. We'd have made even profit. We would have made profits. That's the amazing. That's the beauty of put options. Okay, so now we have learned how to use calls to leverage our money to buy even big stocks like Amazon that cost $736 per share. We know how to control stocks like Amazon for just about for even less of its true value. Now we know how to leverage our money. We know how to hedge our risk. We know how to profit without being liable for margin calls or anything like that using put options. Now we have the knowledge, so we are not clueless and we're not going to get slaughtered that easily now because we know the power of calls, we know the power of puts now. Okay, guys, so now I'm going to tell you one easy way to profit with call options. What we've seen here is the price patterns of IMMU. So basically, what you're seeing right now is called a double bottom. It's basically when the chart price hits support and then it hits support again, basically. And it's confirmed once the second support passes resistance. But normally we always buy a support and then just ride all the way, the break out all the way to resistance. Once you see this is about 60 to 80% chance that it's gonna follow through, and once it supports, it's gonna go up. So basically, you can use double bottom for a bullish trade. In other videos, we're gonna show you the same technical signal and explain a little bit more. But this is just a brief explanation. And once you see this signal in any other chart, it basically means that there's a 60 to 80% chance that it's gonna go up again to its resistance or even pass it. As you see here, it passed resistance. So now, once it hits support, you let it move a little bit just to confirm the bullish movement, and then right after that, you could just buy it and add the money option with a strike price of $2. So now, this is an example. So assuming you have $2,000 in your trading account and you see this technical signal and you want to invest. So now if you bought 18 call option contracts for $1.50 per option at a strike price of $2 with a expiration of 21 days, you would have spent $1,875 to control a whopping 1,250 shares for 21 days. That's pretty amazing. If you would have bought it right by like if you would have buy it by stock, you would have spent around 2,500 around there, 2,500. Okay, now if you would have sold once it hit resistance, meaning when it hit $3.50, you would have profit $2,500. You almost doubled your money right there just by looking at the technical signal and just using at the money options. It's that simple to make money with options. Okay, now after watching this video, you should be able to leverage your money, hedge your risk, and now you have a good understanding of what are options and how to use options. Basically, the tools you're gonna use are calls and puts now. So now you know how to make even more money now through the stock market using options. So in the next video, I'm gonna show you how to decipher an option chain, and that's about it, guys. Hope you have a good day, and I hope you enjoy the video. And if anything, let me know. Give me some comments and.